Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Abhilash and welcome to Cut to the Chase. The biggest development in the past 24 hours has been the progress in talks between Russia and Ukraine. Now, Russia has mentioned that it will sharply reduce military activity near the capital Kyiv and northern Ukraine, and Russia's chief negotiator said that Moscow would take steps to de-escalate the conflict and even dangle the prospect of a meeting between Russian President Putin and Ukrainian President Zelensky. However, crucially, the talks failed to reach an agreement on a ceasefire, and geopolitical analysts were quick to point out that Russia may be withdrawing tactically from near Kyiv to focus its efforts on eastern Ukraine. Nevertheless, US and European stocks rose amid optimism given progress in negotiations and the strong US Conference Board Consumer Confidence Index reading, which climbed to 107.2 from 105.7 the previous month. The US dollar declined on a broad basis, and dollar yen, which we had highlighted as being overbought in yesterday's podcast, actually slipped a little and broke below 122 before closing higher. Now, we expect initial support around 122, and a break below that could accelerate a sell-off towards 121, and a potential for a deeper correction still exists in our view. In the bond space, treasury yields declined across most maturities as hopes for talks between Russia and Ukraine drove down oil prices and inflation expectations. However, yesterday, the 2-year yield briefly exceeded the 10-year yield for the first time since 2019 in a phenomena which is called yield curve inversion. While other parts of US Treasury or government bond yield curve have inverted in the past month as well, the inversion between the 10-year and 2-year yields has historically been viewed as a key predictor of recession. Clearly, the sharp slowdown in growth expectations in US, the prospect of fast pace of tightening from the Fed has raised the risk of a policy mistake which could derail the economic expansion. And while market focus on yield curve inversion is only likely to intensify in the coming few weeks, there are 3 key points that I would like to highlight. First, the yield curve only inverted briefly intraday yesterday before returning to the positive territory. We would actually need to see the yield curve invert on a more protracted basis to count it as a signal. Secondly, if you look at history, going back to 1970s, while each US economic recession has been preceded by a yield curve inversion, each inversion has not been followed by a recession. In other words, there have been a few false positives in past, and a yield curve inversion isn't a guarantee of recession. And third, there can be a fair bit of dispersion in the time between an inversion and a recession. Now, in previous cycles, a recession has followed an inversion with a lag of anywhere between 6 to 24 months. That being said, equity markets usually tend to keep on rising for a few months after the inversion has occurred before eventually peaking. And hence, given the fact that US economic growth still remains robust and most of the other recession indicators are still not flashing red, we still believe it makes sense to remain bullish on global equities. That's all from me today, and if you enjoyed the podcast, please don't forget to rate and like it. Thank you for listening and wish you a very happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.